Okay, so the security market line is the graph of beta against expected return. Let's actually look at this graph on the next slide with an example here. So here you can see beta is on the x-axis, expected return is on the y-axis. So that is our standard template for a risk return plot. You have your risk measure on the x-axis, expected return on the y-axis. Earlier we had sigma on the x-axis, now we have beta. All right. So in this example, you can see, let me actually write down on the whiteboard the inputs here. So the risk-free rate is 6%, expected return on the market is 14%, right? So let me write that down. RF is 6%, expected return on the market is 14%. Okay, and then this is our CAPM equation. The expected return on any security J is risk-free rate plus beta of that security times the market risk premium ERM minus RF, right? So if I have security with say a beta of 1.2, then I can compute its expected return, right? Just plugging in the numbers into the CAPM equation. ERJ is 6%, RF plus 1.2 times 14% minus 6%. Right, and what would that be? So that's 12 times 8 is 96, so 9.6 plus 6, 15.6%. All right, so expected return on this stock with a beta of 1.2 would be 15.6%. So you can see this on this graph here. If you have a beta of 1, that is the beta for the market portfolio, so the corresponding return would be 14%, right? And then if you have beta of 1.2, the corresponding return that we just calculated, it would be 15.6. Beta of 0, so that would be this point here, and with beta of 0, your return would be the risk-free rate of return, and that is 6%, right? So again, it's a linear relationship between beta and expected return. It's a straight line graph, right? So again, to draw this graph, all you need is 2 data points, right? So you can, for example, use beta equal to 0 and corresponding return of 6%, so that would be 1 point, and beta equal to 1, corresponding return of 14%, so that would give you the second data point corresponding to the market portfolio. Just join those two with a straight line, and then you can extend it and you get your plot of CAPM, that is known as security market line or SML. All right, so now I want to talk about this very important concept of alpha. All right, alpha is extremely important from a practical point of view. I mean, if you look at our portfolio project document, one of the websites on the details document that I have suggested is seekingalpha.com, right? So that seeking alpha idea basically is related to this idea of alpha. It won't be an exaggeration to say that pretty much the entire Wall Street is after alpha. So what exactly is this alpha? Alpha is basically abnormal return, right? Abnormal return. So what do we mean by abnormal return in context of CAPM? So again, going back to our example of this security with the beta of 1.2, right? Given the beta of 1.2, what does CAPM tells us that this security should have a return of 15.6%. That is what we can expect, right? So its beta is more than that of the market, right? Market beta is 1. It is riskier than the market, and therefore its corresponding return is also proportionately higher than the market. Now, suppose you have your own proprietary model of valuation, for example, or you do your own analysis to come up with a forecast for this particular security, right? Your model tells you that this security is going to earn a return of 17% over the next year, right? So that is your own forecast. CAPM tells that we can expect a return of 15.6%. If you assume that CAPM is the right model of risk and return, what basically this 15.6 is basically a fair return, right? So for a beta of 1.2 for the risk of that security, the fair return is 15.6%. If you're thinking that this security can actually earn a 17% return, you basically are saying that it will earn a return that is more than the fair return, right? So obviously you would want to buy that security. It's another way of saying that currently the security is underpriced, right? It's undervalued. It is trading below its fair value, and therefore going forward, not only would it earn this 15.6% return, but it would earn something extra as that underpricing corrects, right? So that extra that you are forecasting the security to earn is what is known as alpha. All right, so let's just write that down here. The fair return is 15.6. So forecast, your forecast is 17%, right? That's your forecast. Let me write that clearly here. All right, so this is your forecast, 17%. Again, CAPM return is 15.6%. Alpha is the difference between your forecast minus the expected return from CAPM. So that would be 17% minus 15.6%. So that would be 1.4%, right? So that 1.4% is basically the abnormal return, right? It is more than the fair return and it is positive. So positive alpha implies that the stock or the security is underpriced. You think it will do better than the fair return. So today it is trading below its fair value. It is underpriced. So any active investor would be on the lookout for these type of securities, right? With positive alpha, because the goal of active investing is to beat the market, right? So you want to earn a higher return than what the fair return is, right? So remember, this is risk adjusted performance, right? We are accounting for the risk as measured by beta, and that's how we are arriving at the fair return, right? So we are not just saying that you're beating the market. I mean, you can just beat the market by investing in high risk securities, right? Potentially high risk, high return, right? So we are accounting for risk here. So if you earn 15.6, I mean, that is fair. You're not beaten the market on a risk adjusted basis. But if you earn a 17% return, I mean, that's what you're forecasting. So if you're right, and that way you have basically outperformed after accounting for risk, right? So it's risk adjusted performance, right, that we are looking at here. And so positive alpha, so that return associated with positive alpha, your forecast is going to plot above the security market line, right? Like in this example. And that would be an underpriced security. You would consider buying it. Negative alpha would basically have its forecast plotted below the security market line, right? So if, let's say you forecast, for example, that this security is going to earn a return of 12%, right? The fair return based on CAPM is 15.6. So what's the alpha in this case? 12 minus 15.6. Your forecast minus the CAPM expected return, and that is negative 3.6%. So negative alpha implies overpricing, and you don't want to buy that security. If you hold that security, you want to sell it, right? So that's the importance of alpha, that you are basically looking at risk adjusted performance and then trying to outperform the market or the benchmark on a risk adjusted basis. Okay. All right, so CAPM, as you know, has a lot of uses. I mean, you actually learn about CAPM or use CAPM in pretty much all finance classes that you take. So it is really a landmark development in finance. I mean, prior to CAPM, there was this intuitive understanding of risk return trade-off. Higher the risk, higher should be the return. But there wasn't a precise relationship, right? A model that tells you that if my risk goes up by 10%, how much extra return can I expect to earn? So in that sense, CAPM was a very significant development, and CAPM has number of uses. I mean, CAPM is used like the alpha idea that we just talked about. So it provides us a benchmark for what is a fair return for the security, and then you can evaluate the performance against that. If you think about some corporate finance applications, like you might have learned about capital budgeting, where you are selecting the projects based on positive NPV or internal rate of return and so on. So there you need some discount rate that accounts for the risk of the company, and again CAPM type of models would be useful in those type of situations as well, right? So there are a number of different uses of CAPM. Now, we have talked about the sigma of the portfolio in chapter 6. Basically, if I have two risky assets, how do I compute the sigma or the standard deviation of the portfolio? That is a non-linear relationship, right? That long relationship involving correlations and so on. Uh, it turns out that the beta of the portfolio is actually quite straightforward. It's a pretty simple linear relationship, right? So in this example that you're looking at, you have two stocks A and B. Beta of A is 1.2, beta of B is 1.5, and you basically have created a portfolio in which you're 40% invested in A, 60% in B. What is the beta of the resulting portfolio? Well, all you do is take the weight of each of the securities and multiply it by their corresponding betas and then add that up, right? Weight times the beta. So 40% in A, so 0.4 times 1.2 plus 0.6 times 1.5, you get the beta of portfolio as 1.38. So this calculation is similar to return calculation, right? You when you compute the return or expected return, that is what you do, weight times the corresponding return. Here you're doing similar thing, weight times the corresponding beta added up across all the securities, and you get the beta of the portfolio. So it's a linear relationship, unlike that of sigma, which is non-linear. Okay. All right. So moving on here now. How do we use CAPM in practice, right? So CAPM has all this expected returns built in, right? We need expected return of the security, expected return of the market, and then we also have this issue of what exactly is the market, right? CAPM requires the entire market portfolio, right? Everything that is out there in the market, stocks, bonds, other types of securities. In reality, we cannot actually construct that type of market portfolio. I mean, many of the risky securities in the market are not even traded, like we have private companies and things like that. So you cannot get the true market portfolio. So we have to make some adjustments to the basic model to get a version of the model that is useful in practice, that we can actually apply to real world applications. And that is what an index model is. It's basically a transformed version of the model that makes it operational, right? So we use some proxies here. For risk-free rate, we use T-bills. We have talked about this before, treasury bills. For the market portfolio, we just use S&P 500 for the US market. So S&P 500 index, it's an index of 500 stocks, as you know. So most of the applications of CAPMs are for equities, for stocks. That's why we use S&P 500 return here. And then we just use the historical averages instead of expected returns, right? And that's how we can actually transform the model to get a version that is actually useful in practice. So what you see on this slide is basically that index model version, right? So you see all the expectation signs are gone, right? There are no expectation signs. Instead of using expected returns, we are using realized returns, and so on. And because of that, because of these proxies that we are using, we have some errors that are into the model. That's why we have this error term at the end, right? So that is essentially what we are talking about here, just taking the actual model and making this adjustments to get a version that we can actually apply for real world applications. Okay. This is the beta estimation. So what you see on this diagram is an example of how we can estimate the beta for a stock, in this case Google. So I'm going to skip over this material for now, because when we work on our Excel exercises in a few weeks, we are actually going to do beta estimation for one of the stocks, and we are going to look at a very similar uh, a graphical way of estimating the beta that you are looking at here. So I'm not going to go over this at this time, but we'll work on this type of example later on in our Excel assignment class. Okay, and you can also do beta estimation with Excel. So this is the Excel version of that same exercise, beta estimation exercise. So you can either do it graphically or using Excel. And again, in our Excel assignment, when we work on it in class, we'll do it both ways. So I'm going to skip over these couple of slides here and move on here. Now, one other thing about beta is that beta tends to be mean reverting, meaning that stocks that have high beta today, their beta on average it tends to go down. Stocks that have low beta today, their beta tends to go up over time, right? So there has been this observed tendency to revert to one, right? One is the sort of the market beta, so it's sort of like the average. So this is like regression towards the mean. And what people sometimes do in real world applications is, because of this tendency for the beta to revert to the mean, they adjust the beta. So let's say you compute the beta and beta turns out to be 1.5, right? Then you know that on average when beta is higher than 1, it tends to go towards 1. So instead of using 1.5, you use like a somewhat a smaller beta in practice sometimes, so to account for this mean reversion tendency. Okay, so if you look at like the softwares like Bloomberg and other softwares, sometimes they provide you this adjusted beta, which is adjusted for this mean reversion tendency. All right, so we'll talk about other asset pricing models next.